since residential is very regulated, you got to go through the regulation process, and it takes it's a much more longer process. Whereas commercial, for the most part, commercial isn't. It doesn't take that much it's not as long of a process as it normally would be for residential. That's pretty much the real difference there, is that it isn't as much of a long process. Can it be tedious? It depends on the property type. But a lot of the times it isn't that tedious at all.
Welcome to the J. Wells CFO Show. I am your host, Jeremy Wells, and with me today is a guest I'm really looking forward to talking to. It's been a good contact for me for the last few months here, and really happy to have him on the show. This is Sean Gauthier. Sean is a wholesale mortgage broker. Make sure I get that right, with Smart Home Loans. He's going to tell us all about how mortgages work, get us introduced to that idea, and tell us a little bit about how he's helping people out there. So, Sean, I'm going to turn it over to you. Tell us about your business. Tell us about what you're doing, man.
Hey, thanks, Jeremy. Thanks for having me on your show. I appreciate it, man.
Appreciate you being here.
So thanks. And again, I'm Sean Gauthier. My company name is Smart Home Loans. We're located here in North Florida, specifically Point Vedra, Florida. I have an office in Pembroke Pines, which is in South Florida, and in Cape Coral as well. So we're kind of branched out everywhere, trying to cover the whole state of Florida. And I started in the business about 10 years ago, and I started in retail. Retail. What does retail mean? Retail means that I worked for a big bank, and what a big bank is you're subject to whatever the big bank offers, and that's what you give to your clients, right? And you're limited. You're limited to what you can offer your clients. And what I mean by limited by products, limited by rate, limited by costs, right? And whatever I had to offer my clients, that was it. And I didn't really give them much of an offering, and that wasn't great for me. And so over the years, I struggled through and worked with different lenders and tried to figure out, where I should go. And I felt, okay. And it wasn't until just up until recently, I said, you know what, I should become a wholesale mortgage broker, because now I can offer borrowers better rates, wholesale rates, right? I can give them better options. I'm attached to 35 different lenders nationwide. So I've got you covered. I've got you covered in all different residential type of products, down payment assistance programs, commercial lending, investor type loans, hard money loans. And now I can be more competitive. And because, we're in a market where the end user or the borrower is only conscious about, or conscientious about one thing, really, and that's rate, and what comes next is closing costs, right? And so once they see, where I come in with the interest rate, and then we have a conversation of, this is what your fees are going to be, then all of a sudden, their mouths drop. Like, it's unbelievable from where I was in the retail space working for a quote unquote direct lender or a big bank to the wholesale side of the market. So, it's been great overall for my business, and also for my borrowers, because now my borrowers are realizing, wow, contacting an independent mortgage broker like myself is 100 times better, because you're talking to me, right? You have the inside scoop of what's going on, because you've got years and years of experience because of me and my staff here. There's 9 of us all together. And we're really going to help you from genesis, from the beginning of your loan application or getting a pre-approval to the very end. I'm not going to say getting a mortgage is easy. It's stressful. It's stressful for everybody. Going through this process is stressful, but we have the experience, and we have come across so many hundreds, not even thousands of different scenarios that we've gotten through the deal, right? And so I guess the whole, at least our mantra behind everything is making sure we give you a great deal, right? And we get you 100% satisfied, and you're happy through the whole process. Um,
Well, let me ask you this real quick, because yeah, so a couple things that came up in there. I've gotten a couple mortgages myself, but I'm not a real estate professional. I'm not a real estate investor. So my experience with the mortgage industry, and really just the real estate industry as a whole, is pretty light. And it's all on the consumer side. So when you say you have multiple products, right? I think, I'm getting ready to buy a house. I'm going to get offered a mortgage. I'll get pre-approved or something. Here are the terms. That's it, right? I don't really see a lot else. So when you say products, what do you mean? Like what kind of options am I going to get with you that I wouldn't get with, say, going to my bank or credit union?
sure. So we have for different products, meaning I have we have relatively the same products. Like FHA is a product, which is an FHA loan, and that's pretty much used for your first-time home buyer. I have a conventional loan, which is also can be used for first-time home buyer as well. This FHA loan is a government loan. A conventional loan, it isn't a government loan. Really, the difference between the two is that with an FHA loan and conventional loan, anything less than 20% down carries mortgage insurance, which is a premium that gets added to your monthly bill every month. The difference between the two products is that with conventional, that mortgage insurance premium, once you have 20% equity in the property, it falls off. And the only way it falls off is through an appraisal. An appraisal needs to get done. Now with FHA, that doesn't happen. It gets the mortgage insurance premium is tied into the loan throughout the life of the loan, unless you refinance, right? And when you refinance, you are subject to closing costs at that time and whatever the rate is at that time. Now, in terms of different programs that I have access to, every lender is uniquely different, meaning they offer maybe a different rate, a different coupon for a rate, a different incentive in terms of maybe a free appraisal, maybe a different credit towards their closing costs. Maybe there is also a different, there's always, depending on your credit score and how much money you're putting down, I can get you into maybe some other program that would certainly benefit you way better than anybody else could, because all of a sudden you are coming to me and I'm branching out to the masses instead of you coming in. All right. And you should do your due diligence as a borrower. You should shop me around. Shop me. I encourage it, right? Because now you're doing your due diligence. But when it comes to, you're not going to spend the time of, reaching out to 35 different lenders. You won't do that. Maybe 2 or 3. Okay, that's reasonable because you've done your due diligence. But all of a sudden, if I'm giving you 3 and I say to you, you come to me and I'm giving you my 35, here's your best one. This one makes the most sense. And then the light, pops up and you're like, all right, this is really my best option. And it's great. I compete directly. So Quicken Loan, everybody knows Quicken Loans. I wholesale to Quicken Loans as well, right? They have a wholesale division, and then they have a retail division. Retail division is what your typical end user will go to, a borrower go to. And the rates and costs are significantly different. You'd be surprised. The incentive to come with me is so much more significant. They build in a pretty sweet package on the wholesale side that it's so much more better. The hardest thing for me, because I'm not a big bank, is advertising, getting to the masses. That's the hardest thing for an independent mortgage broker, because Quicken Loans has their marketing is limitless, right? Whereas mine, it's a budget. So, I have to do whatever I can to get out there on social media, to shake hands, to be out in the public, to really have these sort of podcasts and to educate you guys and to bring you guys in to give you options.
But when someone comes to get a loan from you, they're not paying for your big advertising budget either, right? So they're not
That's
getting
right.
that cost passed on to
That
them.
is right. There's no overhead with me. That's right. So,
Absolutely.
I'm not paying for the insurances. I'm not paying for my staff and the lighting and in the office space. It's a wholesale rate with wholesale costs. So it's
And I appreciate that business model because that's my exact business model. I'm not here to generate costs just to pass them on to the client if I don't have to. If it's something necessary for providing that service to the client, then yeah, I'm going to pay that cost and I'm going to factor that into my billing. But so in my own field, right, I look at a lot of accountants, especially CPAs, that have really nice offices with fancy office, fancy conference rooms and nice furniture and that kind of stuff. And yeah, they look like cool places to go in and sit down and have a conversation for 45 minutes. But you know what? I can meet you at a coffee shop. We can have that same exact conversation, and it costs me nothing. Therefore, it costs you nothing.
exactly.
Yeah.
Exactly.
Yeah. Good deal. Good deal. So yeah, what all goes into, so I find a house that I want to buy. I get a realtor. The realtor, we figure out the price. We've got this deal, but I'm going to need to finance this, right? Now I've got to start thinking about, how do I actually fill in the gap between the money I've got sitting in the bank account today and what I need to actually bring to closing, right? What all is going to go into that, and how can I work with a mortgage broker to bring that number down as much as possible?
Good question. So here's what I like to do. I'm really aggressive and tactical in structuring some deals, right? If a borrower comes to me and they really want to buy a home and funds are very limited, right? There are down payment assistance programs that are out there, and some of them are okay. They work. But a lot of them, they limit you to your ability to purchase, meaning um, specifically, like there are programs where you can buy a home for X amount of dollars, and it's based off of your debt to income ratio. Okay. And then when you go into these down payment assistance programs, your debt to income ratio was here by qualifying just on your own. But now that you're asking for another resource to give you some money, your debt to income ratio goes down to here, which is lower, which now prevents you from purchase. It limits your buying power, right? So now your buying power isn't as much. So here's what I like to see, though, a lot of the times. If you can come up with the minimum down payment for FHA, right? Since it's a government loan, rates are traditionally lower than conventional finance. Okay. And what I can do is I can provide you with a lender's credit. Now, the only way to provide a lender credit, you're asking me, what is a lender credit? Well, the only way to provide a lender credit is to increase the rate ever so slightly. Okay. And it might be worth it because the difference in payment is probably, I don't know, $20. And if I can give you a $5,000 credit and it's only a $25 or $20 difference in payment, wouldn't you do that? Especially if you're going to live in the house for only, on average, 5 to 7 years, because that's what a first-time home buyer stays in their house for, between 5 and 7 years. Not very many stay in a long period of time like you think. I myself have purchased and lived in these homes. I haven't lived in one single home for more than 4 years in all the homes that I've purchased, and I've purchased 7.
Wow.
But you see that a lot, though, in terms of the what's going on in just all the data that's out there. Most first-time home buyers live in their home at maximum 7 years. So when you calculate the $25 a month that it's costing you extra for the $5,000, so if we do $25 times 12, that's $300, and we say 7 years, that's $2,100,
Hmm.
right?
And
Wouldn't you
you
take
say,
that
yeah,
5,000? Sure, I would.
yeah.
Definitely, it feels good because it's now all of a sudden I didn't have to come up with the. I might have had that $5,000, but now it's sitting in my bank, right?
Hmm.
Um, and here's another way of doing it. So I would say to you, all right, if you can at least come up with your 3.5% down, let's see if we can find a motivated seller, right, who's willing to contribute towards your closing costs,
Hmm.
right? That's out there, and sometimes we can ask for that, and then I can help with the seller's with a lender's credit. So when the seller's helping and I'm helping, all of a sudden we have a nice picture here where we're not having to come up with a whole lot of money to come up and purchase a home.
Wow.
So a lot of millennials, it surprises me, a lot of millennials think that they still have to put 20% down on a home, right? That's not the case. You can put as low as 3% down, right? And if you're tight on funds and your credit is so-so, it might be best that we go FHA because then I can help you. I can help, um, with some of those costs, and we can talk to the realtor, your realtor, and say, you know what, we've figured out a strategy here based on the funds that we have. We'd like to see if we can find a home where the seller is very motivated to help, well, one, to sell their home and to contribute towards the closing costs, right? And then we have something here. We have a good deal. I just did this with someone here. It was a $330,000 purchase, right? And we it was a hard deal. And but here's what happened. I knew I had limited funds to work with, only $12,000, right? The seller came up with $10,000,
Hmm.
right? But you can't contribute. You can only contribute three. It all depends on the guidelines. But anyway, the seller was willing to contribute $10,000 towards the closing costs, and I myself was able to contribute another 2,500.
Hmm.
Okay, and she had a 635 credit score, and I gave her a 3.75 interest rate.
Hmm.
That's what we closed in at 2 weeks ago. I mean,
Interesting.
that's a killer deal,
Yeah.
right? And that's what happens when you're on the wholesale side. It's like you're not working with the big bank. You're working with somebody. We'll strategize with the realtor. I'll get the seller involved. I'll talk to them. I'll talk to everybody and say, you know what? We're all on the same page here, trying to make something happen, trying to make the deal happen, and everybody will work together. It's funny how it's funny if the lender doesn't talk to the seller, how things play out. It's not a smooth transaction. But if I pick up the phone and call the seller, if both the realtors don't mind that I do that,
Hmm.
which most of the times they don't, they say, you know what, go right ahead. I talk to them, I tell them what's going on. This is the strategy. This is what we're doing. The sellers love it. They say, you know what, great, Sean. I'm glad we have your contact information. Reach out to us anytime. We'll be happy to help. And that's what I see a lot of. It's setting proper expectations. Setting proper expectations. That's that's a strategy in and of itself, all
Yeah.
right? But you got to set proper expectations.
Yeah.
And
Yeah. No, that's interesting because what I've seen as sort of the typical uh, experience is you you get interested in buying a house. Well, how much can I afford? Well, I don't know. Let me go get an amount from whoever's going to, be the lender and, in a pre-approval or something like that. And now I know how much I can spend. So now the realtor and we go out and we find a house and, it's just me and the realtor, right? We're doing this for a long time. We finally find the house and then, we put in the offer gets accepted, passes the inspection, passes the appraisal. Good job. Way to go. And then we get to closing and it's kind of this just, um, this anxiety that builds up toward the day of closing, hoping that all the numbers stay kind of the same, what we expected. There's no big surprises at closing. And I've heard horror stories of, people walking into the day of closing and the numbers jump, and for nothing that they knew was going to happen. And so um, what you're describing though sounds like much more of an interactive kind of relationship that you keep working throughout the time that we're trying to find the house. Then we find the house, then we try to get into the house, and it sounds like a very different model than the one that I tend to see.
Yeah, you have to have a relationship with all the parties involved, because at the end of the day, we all are commission based, right?
Yes.
And we want to make sure that we're doing a great job, right? And we everything starts off with a pre-approval, and a pre-approval, not a pre-qualification. They're significantly different. Pre-approval is one thing, and it's I've taken your credit, I've pulled your credit, I've looked at all your financial documents, I've looked at making sure that you have proof of funds, right? I've made sure that I can verify your employment, right? And I've run this through an automated system, and the automated system gave me the results that we want and approve eligible, right? Because an underwriter is going to look at the results of this automated system that I run to get these results, and is going to look at this card. It's a report card of my borrower, and he or she, the underwriter, is going to say, all right, well, based on these findings here, we're going to dig a little deeper and make sure these findings are absolutely correct. And they're going to request more evidence, or we call them here conditions, but they want more evidence just to verify everything is sound. And then once we go through that whole loan process, you're going to get a clear to close, right? And that clear to close, at least 99.9% of the time, is good. There are those occasions where, yeah, it's true. All of a sudden you could be at the closing table and something could change, and a lot of the times though, that stuff is, it's not in our control. From what I've experienced, it's not something that I can control. It's all of a sudden like a title thing that just didn't get caught, or it's something weird that wasn't foreseen at all. It's not part of, it's like these one-off things that, like, oh wow, like I can't even believe that happened. It's like, but it happens. It's true. It does happen.
Hmm.
But we're all striving to do a really, really good job, and we work hard. And I want to make sure, I get positive feedback from everyone.
Gotcha. Good deal. So let me back up to something you mentioned earlier. You said you do both residential and commercial
Yep.
mortgage lending. So in an earlier episode, we had Fernando Crisantos, a commercial realtor, on, and commercial real estate agent. He sort of got into the differences on the realtor side of the differences between residential and commercial property. Are there any differences on the lending side, and what are those differences?
The lending side, it's a little bit smoother of a process because it's not as regulated, right? Since residential is very regulated, you got to go through the regulation process, and it takes it's a much more longer process. Whereas commercial, for the most part, commercial isn't. It doesn't take that much it's not as long of a process as it normally would be for residential. That's pretty much the real difference there, is that it isn't as much of a long process. Can it be tedious? It depends on the property type. But a lot of the times it isn't that tedious at all. There are other types of loans too that are called investment type loans, or non-QM, non-qualifying mortgage loans, and these are for your self-employed or investor type borrowers. Self-employed borrowers are unique, and a lot of the times, they may not qualify for traditional financing, um, FHA or conventional financing, because they're only claiming so much money. And, when we all of a sudden look at that income and then we compare it to the debt that they have, they may not fall into that debt to income bracket that we need them to fall into to qualify for a conventional loan. So the other options that we have are these bank statement type loans. And there's a few other ones, but the most popular one out there is a bank statement loan for a self-employed borrower, because we just look at the deposits over a period of 12 months, or it could be up to 24 months, depending on the credit score. So if you have good credit, 12 months, we look at the deposits, we generate an income based off the deposits that are being made, and we have an income, and you have a loan, right? You're not having to pay you don't have, you're mitigating what you have to spend um, in taxes by doing this
Gotcha.
loan. Now, is the rate the same? No, it isn't the same. Is it competitive? It is. But when you compare it to how much you would pay in taxes versus an interest rate, you would want to go with the bank statement, a little higher interest versus paying your taxes.
Yeah. Right.
I mean,
Right.
when you do the dollar for dollar, it would make more sense to go with a bank statement type loan.
Gotcha. Interesting. Interesting. So you mentioned rates quite a bit, and not to date this episode, obviously, because I think we're always hearing headlines now, or at least we have been for years now, right? About interest rates and where interest rates going, and are they going up? Are they going down? Does this mean the economy is going to slow down or ramp up? All these different kinds of things. How much of that do we as consumers really need to pay attention to when it comes to, can I get a mortgage with a decent payment this year?
Yeah. Rates in August had significantly dropped. The end of midway in July through August, it was a great time to, between July and August, a great time to refinance. Even if you purchased a home in January, I was calling borrowers who purchased in January to refinance now, because rates had dropped nearly a point. Phenomenal. And a point and a half in some cases.
Hmm.
And you want to know what? Rates had gone up again, just slightly. They come back down. They kind of do peaks and valleys daily. If you're really one of these guys who really watches the rates, and rate hawk is a term that we use in the industry, and I'm not one of them, but I do see how the market is moving. And anytime the president ever says something, it immediately impacts interest rates. He said something last night, and I'm like, all right, let's see what the interest rates look like today. And all of a sudden they're up, 15 basis points. So it's interesting how that plays out. But tomorrow, Monday, you'll see them come back down again. And rates are still lower now than they were at the beginning of the year, I want to say. So you're going to do okay. And I don't see the rates, interest rates, and, and here's another thing too, interest rates. And when the Fed says, oh, we're going to drop interest rates, they kind of play together, but not really. The interest rate on the mortgage side is tied into the bond market and a few other factors. And so the marketing really will determine where the bond market goes and how that impacts the interest rate. And it's interesting how that plays out on a day-to-day basis. But as far as a consumer goes, you'll be okay. And you'll especially be okay if you can find me, a wholesale mortgage broker, who can hook you up.
Right. Absolutely. And so obviously we have the sort of national, regional, macroeconomic kind of level factors that are causing those fluctuations, like you're saying, and should I, if I'm in a situation where it might be more difficult to get a loan, like I've got a worse credit score, like you're saying, or maybe I don't have solid proof of income for a while, or just for whatever reason, I know it might be a little bit more difficult for me, and I see that mortgage rates are really low, right? Does this mean I need to jump all over it, or is there still some personal responsibility there that just because rates are low doesn't mean I can just walk in and now get a loan all of a sudden?
Well, um,
Yeah, I guess what's the balance between the personal, the individual factors, and then these sort of bigger economic factors, I guess. How does that play into your calculation on the lender side?
I always recommend buying real estate. Always. It doesn't matter when. If interest rates go up higher, fine. They go up higher. But you're never going to get the return you're going to get when you purchase real estate, especially when you look at appreciation and when you're paying down the principal. Okay. If all of a sudden I'm putting $15,000 into a home and in 5 years I've made $60,000 or $70,000 on a $15,000 purchase, and I don't know what my mortgage payment is going to be. Let's say, let's say this. Let's say I put $20,000 into a home, maybe less, meaning to your down payment and your closing costs cost me $20,000. On average, homes appreciate here in Florida, depending on where you are, but for the most part in Florida is about 4.5%. Okay, so $20,000 will probably buy you a $300,000 home. So if we do $300,000 times 0.05, in 1 year, my home has technically appreciated $13,500. Okay, I'm at year 7. I've all of a sudden made nearly $100,000 in appreciation, assuming the market continues to, go that trajectory, right? Well, let's say it doesn't, and you cap out at $75,000. Where are you going to make $75,000 on a $20,000 investment? I mean,
Yeah.
can you go into the stock market and do it? Sure, right?
You gotta get really lucky.
Yeah, you kind of have to know your stock market, right?
Yeah.
And then all of a sudden, when you compare that to rent, as you know, at least some of your principal is going towards, getting that mortgage payment, that principal amount down. So your mortgage payment, some of that is principal, and it's taking away from that principal payment. So your loan amount was $300,000. Now it's all of a sudden 280, let's say. So you've now you paid $20,000 into it, and you've appreciated another $75,000, and then you compare that to rent, right? Once you've sold your home, let's say you've sold your home and you made. I'll give you one example. Here's my example, my personal example. I bought an FHA home 3 years ago. Okay, cost me $330,000, right? And to do the loan altogether was $21,000 or $22,000. I sold my home for $390,000 just 2 years later. Okay, I bought it for $335 or $330, and I sold it for $390. And my wife's a realtor, so I didn't have to pay all the realtor fees, but there was some fees there. So, but still, at the end of the day, I made about 50. I don't know, about $60,000.
Yeah.
Now, when I multiply my mortgage payment, which was probably about $2,200 a month times 12, that's $26,400, right? I, and so I walked away with $60,000 in my pocket, meaning I didn't really capitalize on it that much, but I lived there for rent free. If you think about it, I lived there for rent free. Was that a good investment? Yeah, because if I was renting, I would have gave 50,000 or $60,000 to someone else to pay their mortgage.
Yeah, I think
So
it's been a big debate over the last few years because we've seen these, especially urban areas where the rent is through the roof, and housing prices in general are up, but especially the rent is through the roof. I'm thinking, I've got a few clients in San Francisco, places like this where it's just simply unaffordable. And so, yeah, I remember there was a famous article in on the New York Times website a couple years ago that had this interactive part where you could plug the numbers in and compare whether renting versus buying a house was the right option for you. And so I've heard a lot of these arguments and a lot of these comparative sort of calculations that show that, look, unless you've got some specific circumstance, or unless you're in some specific area, 9 times out of 10 it's just going to make more sense to buy than it is to rent.
absolutely, I agree with that. But it also depends on the circumstance too. And I will tell you this: let's say if I was some executive and I the executive, I had a contract with, let's say, IBM. IBM says, you know what, Sean, we want you out here for the next 3 years. Um, and I'm like, and they want me on San Francisco. So, you know what? Okay, great. I'll move out to San Francisco. Perfect. Now, I want to buy a home. Would it make sense to buy a home if I'm only going to be there for 3 years? I will say this. I think it would make sense to buy a home because you want to know why? I wouldn't go for the 30-year fixed mortgage. I go for the 5/1 ARM. Why not? Because all of a sudden, San Francisco is a market that always goes up, and it always has gone up, right? So why not capitalize in the appreciation of that home during the 3 years that you're there? I would. Why not? It's a great buy. And I wouldn't take a 30-year fixed mortgage because I already know, like, a 30-year fixed versus a 5/1 ARM, it's going to be less all the time, right? And if you already know contractually, I am only going to be here for a certain amount of time, and that loan product makes the most sense.
Hmm.
That's something you could talk to anybody about. I mean, I
And
could
I
talk
guess if you're Yeah, and I guess if you're like me and you don't exactly know what all that just meant, then get in touch with a mortgage broker who can explain it to you.
right,
Yeah, yeah.
right, right, right.
Absolutely, absolutely. Good deal. Well, uh, Sean, let's for a moment here. Let's think about some people who might just be getting started or thinking about starting a career in doing mortgages. What advice, what recommendations would you have to give somebody who's thinking about getting into this line of work?
You know what? I was thinking about that recently, and I thought, if I were to start this career all over again, how would I go about doing it? And I would go work at like a Wells Fargo or a Bank of America for a year or two, only because they've spent millions of dollars, millions, to train you and to get you into, how your mind should be thinking about loan originating. And they have the resources there, the training there, because you need to be trained, and you need to get as many loans as you possibly can, so this way you are educated and have the experience when you come across. There are so many different scenarios because everybody's situation is completely unique, completely. And it's not like I'm given all the information up front, right? A borrower will give me information, and then an underwriter will come back to me and say to me, "Hey, Sean, there's some additional information I need." And a lot of times I go to a bar and they say to me, "Oh yeah," and then there's more information that unfolds, right?
Right.
And we have to work through that. That's fine. That's part of that's part of this whole business anyway. But I think, at least initially, um, working for a big bank isn't a bad idea. It's not, because it gives you the training you need, right? And you want to have that training, because then when you come out here and become a mortgage broker like myself, um, you've had the right amount of experience to get out there and have like these one-on-one conversations like that we're doing, or I'm talking to a borrower that has a unique situation. I have probably already worked with somebody in a similar type of situation that I could apply that to here. And then we can have a dialogue of how we can generate a loan for you. Maybe not now, but maybe I get them on a 6 month or a 1 year plan. Maybe the credit isn't looking so hot. And I have resources, and or myself, I repair people's credit all the time. You know, I'm doing someone's credit right now where it's bad. And I'm like telling her, look, this is what you got to do. This is where we'll be. You know, go from a 600 to a 690 in less than 30 days, right? That's great.
Interesting.
And that's what we want to do.
Yeah.
So that's my recommendation. Just start off, you know, where you're going to get the most education and the most, like I said, the big banks have all the marketing power, right? They're bringing in a ton of business.
And looking at, and listening to your story, it also, you'll see those those sort of standard ways that the industry is doing it, and figure out for yourself what of that works, what of that doesn't work, and think about how maybe you can improve on some of that when you take it to the next stage of your career.
Yeah, absolutely.
Yeah. Good deal. It's kind of what I did. You know, I had been running my own accounting firm for a little bit, and then I went and got a job with a small local firm. And through that process, like you're saying, I learned a lot. You know, you know, I might have finally figured it out on my own, but because of that experience, I learned it a lot quicker, you know, than I would have.
Yep.
But then at the same time, I also learned a lot of things that I knew I wouldn't want to do in my own practice, you know, or how I would do things, at least
Right.
I think, in a better way, right? You know, and we're still seeing if it actually plays out that way. But you know, you get an idea of what works for you and what doesn't. So yeah,
Yeah, for
absolutely.
sure.
No, that's interesting. So, Sean, if listeners want to get a hold of you, if they want to learn more about mortgages and how mortgages work, and maybe do some business with you, how can they get in touch with you?
Sure. My name is Sean Gauthier. Again, my number is 954-707-8198. Call me anytime. I work weekends, Saturday and Sunday. I'm always picking up my phone. Text me, email me at sean@smarthomeloans.net.
Good deal. Well, we'll make sure all that is in the show notes and the description of the video, so that people can get in touch with you. Thank you, Sean, so much for being on here. Really appreciate it. I've definitely learned a lot about mortgages, and I think this is definitely, you threw some things out there that I'm completely unfamiliar with, so we'll probably have to bring you back to get into some of those details a little bit down the road. But thank you to all the listeners and the viewers for tuning in. Like I said, the show notes and description will be available, so that you can get links to get in touch with Sean or get in touch with me in the show. You can follow me at JWellCFO on just about all the social media, including Facebook, LinkedIn, Instagram, and Twitter. This has been the JWell CFO Show. I am Jeremy Wells. Again, guest Sean Gauthier. Thank you so much for being here. Thank you, and have a good one.
Thanks, Jeremy. Take care, man.